welcome and thank you for joining me today for today's webinar, which is the importance of tax planning. So a big thank you to everyone. While we're getting everybody in, I'd love for you to put in the chat, type in the chat, whereabouts you're calling from today. So I'm in Indonesia. Typing that in. So I got up this morning and it was raining and it's still raining, but yesterday was sunny. So I love Indonesia for weather. So if you'd love to stick in the chat whereabouts you're calling from, we'll just make sure everybody's in and then we will kick off. So today is all about tax planning and why it's important for your business and for you personally to do tax planning. So I've got a couple of questions for you and I'd love for you to stick a Y, or if you're fast typer, stick yes in the chat if this applies to you. So who here wants to be more proactive in their business instead of reactive? Definitely yes for me. Proactive is the way to go. And then who thinks that paying taxes is scary, or it could be scary? I get a little bit scared of taxes, even though I've been a tax agent for a very long time, for over 20 years, and it can be scary because of the unknown. Now, my name's Jodi and I'm here today to teach you some things about tax planning, not everything, and it won't be specific advice, it'll be general advice. But the reason why I'm here and showing up for you today is because tax planning is one of those pieces of business that most people stick their heads in the sand and ignore taxes until the absolute end of where you have to be. And when this happens, tax isn't then proactive, it's reactive, and you feel like you're working forever to pay tax. Now, I have been in business for over 20 years, and as an accountant, I've seen a lot of businesses fail in their business and have to shut down or go bankrupt or go into liquidation because their finances weren't under control. So I'm here to show you how you can optimize your finances and get your taxes under control so that you don't feel the stress, you don't feel the heartache of having to shut your business down early or unplanned, and your family and your relationships are more positive because you've got a better handle on taxes. So in prepping for today's webinar, I thought it was hilarious, not hilarious, but good timing that yesterday I had a session with a client who we ran through exactly some of the conversations that I'm going to be covering today. So when I met with, I'm going to call him Bob, when I met with Bob yesterday, he said, look, I'm terrible with money. I'm scared of doing my taxes. I've got some money set aside in my tax bank account, but I'm not sure that it's enough. And so that's keeping me back from doing my taxes because I don't know. So we worked through how we could circumvent that, and we'll touch on some of those strategies today and make him feel more prepared and more proactive in relation to taxes and reporting and doing everything he needs to do so that he doesn't have to pay so much money in tax if that's an outcome, but also just so he understands that when he does come to do tax time, it's not scary at all. Okie dokie. So with the introductions out of the way, I've got a little poll for you. So a little question here in the poll for you to answer. And it says, do you understand the different taxes that you pay as a business? And I've got 3 options for you there. So I think you can just click on the poll and then press OK or submit. So I've got a couple of people already saying not really. Well, you are in the right place. So thank you for joining me today. So what I'm going to do to start off with is run through a little timeline of how taxes come up and show up for you in business. Now, this timeline is specifically for those businesses who are sole traders and companies. So if you're operating as a trust, it's a little bit different to this, not a lot, but a little bit different to this. And it assumes that we're starting off a business on the 1st of July. So thank you for answering that poll. If you're still interested in answering, then go ahead. I'm going to close off in just a moment. So that's that one, and I'm just going to grab my screen share while I'm doing that. Here we go. Right, tech all over the place. Here we go. So with this timeline that I've got 3 years worth of timeline. So the first year is your first year in business. And nobody asks you to pay income tax. And we often, as tax agents, forget to tell you, hey, hold some money aside for tax, because we don't know what your business is going to be doing. We don't know whether you're going to make a loss for the year. We don't know if you're going to make, oh no, my internet has just come up unstable. Hopefully it's okay. We don't know whether you're going to make a loss. We don't know whether you're going to make a $5,000 profit or a $10 million profit. It's really unknown for everybody in those first years. But my advice is always to keep some money aside for tax. You better have some money set aside than no money set aside. And as we go through, we'll have a look at how all the taxes layer upon each other. So the first year, the 1st of July here is the first day that we're starting our business. So we start our business, we get our income in as normal, we pay our bills out as normal. We're registered for GST. So registered for GST, collecting GST, paying out GST as well. By the time it comes to the end of October, start of November, we want to lodge our first business activity statement, and that's the BAS. So the blue dollar signs here are our BAS figures that we need to pay. So we've started operating in July. We don't need to pay our first BAS until the end of October or the middle of November. So there's already 3 months plus another 6 weeks. So 4.5 months worth of trading, where you then go, oh, damn, I've got a BAS to lodge and I've got to pay tax. So hopefully by this stage you have got some money set aside. If not, you'll feel like you'll have to work for a couple of weeks to get the money in to pay for the BAS. Hopefully that's not where you're sitting at the moment, but this is absolutely what happens on a regular basis. Then we keep trading. So October through to January, we keep trading, and there's another BAS due at the end of February, and then we keep trading. There's another BAS due at the end of April, early May, and then we get to the end of the financial year. So the financial year in Australia is July to June. And what we've got in July to June is our full financial year. My internet is showing as unstable, so hopefully not working. So at the end of the first financial year, we've then got can hear and see. Great, thank you. It just keep coming up with warnings. So then we've got July to June. So that's our first full year of trading. So after this, we then have to lodge a tax return. So it doesn't have to be done in the first week of July. And from an accountant's point of view, we're probably not ready for you to do in the first week of July. But if all of your books are up to date, then we can get your taxes done early versus later. So this first year's worth of tax return is actually due either, depends whether you're a large business or a small business, but generally the small businesses is not due until May the following year. So you've got 11 months essentially from the end of the first year to then lodge and pay your tax return. So what I've got in the second section here is the red one is when we lodge your first tax return. So I'm just being nice and generous here and saying we're going to pay your first tax return in November. What happens then is if your business has made a profit and you have had to pay tax, is the tax office is then going to ask you to pay as you go installments to make sure that when you lodge your next tax return, you've already paying some of that tax in advance. So you can see in the second year, we've got the red, this is your first tax return. We've got the blue basses continuing on, and then bam, in that third quarter, we've got some green dollar signs. And I've put a lot of green dollar signs there because the tax office normally spreads out those installments over the year. So they'll say if you had a tax bill of $10,000 in the first year, they'll say, well, you should be paying $2,500 on every BAS, so that when you lodge your next tax return, you've already paid $10,000 in advance. But what happens is you've not paid installments because the tax office hasn't asked you to, because you haven't lodged your tax return yet. And so it'll hit you with a double whammy or a triple whammy in that third BAS, because it's trying to make up all of the old tax that you haven't paid yet for this year, and then get to a point where by the end of the second year, you've paid all of the tax ready for the next tax return. So second year tax is so super hard for most small businesses because they haven't put money aside for tax to start off with. They've just been paying the business activity statements and getting the GST side of things done. And then all of a sudden they're whopped with the tax return bill and pay-as-you-go installments as well, which is next year's tax. So we're paying last year's tax and we're paying for the next tax return all at the same time. So this is where I see a lot of small business owners coming to me and going, why are we even doing this where there's so much tax to pay? Where in the first year, if we'd have just put a percentage of all of our income aside to pay tax, then we would have enough money for the BASs, we would have enough money for the tax returns, we would have enough money for the pay-as-you-go installments before we get to the point where we get that double whammy of tax plus installments as well as running the BAS as well. So if you do have any questions about this, or if you want more clarification, please type your question in the chat. I love answering questions in the chat. Please go ahead and type that in. Now, by the time it gets to the third year down the bottom, we're almost on a roll. We're still probably a little bit behind, but we're almost on a roll. So we're paying our BAS, we're paying our pay-as-you-go installment, paying our BAS, pay-as-you-go installment, paying a BAS, paying pay-as-you-go installment. Now this time I've lodged the BAS a little bit later. So I've paid it in that January to April month, timeframe, quarter. And so what happens if you lodge your tax return a little bit later? They're going to do that same double whammy. So I said if your tax bill for the second year is $10,000, they'll want extra money so that you can pay $10,000 by the time you lodge your tax return. Then what happens is if the next year, your third year, you pay $20,000, there's a $10,000 top up. So you'll pay that extra tax and then they'll up the dollars for the installments again. So every single time you lodge a tax return, the tax office automatically updates the pay-as-you-go installments to roughly that divided by 4. So a $20,000 tax bill, they'll ask you to pay $5,000 every quarter, so that by the time you do your tax return, you've paid the same amount. Now, all of this is absolutely changeable. So if your business is going up and you want to pay more, you can absolutely pay more. If it's going down, you can absolutely pay less. Just work to make sure that you've got those correct calculations in place so that when you do your tax return, there's nothing much extra to pay. Now, Chelsea, thank you for that question. Is payroll tax different again from BAS and pay-as-you-go installments? Yes, it is. So if you've got wages for your staff, for your employees, or if you're paying yourself a wage, then you've got your pay-as-you-go withholding tax. Now, I am not a lover of the tax or the government making the same acronyms and the same words for different taxes. So pay-as-you-go installments are the installments towards your tax bill, but pay-as-you-go withholding, PAYGW, is your wages tax. So I love that withholding and wages are the same W. So your pay-as-you-go withholding will be paid on top of your BAS, so on top of your GST. So we generally just include them together. So your pay-as-you-go withholding, your wages, and your GST are all paid on the blue dollar signs, and then the pay-as-you-go installments will come in later after you've lodged your first tax return. Now, this is all assuming that your business is making a profit, which it should be, because the reason why you're going into business is to make a profit. And what I find when I talk to some people is they go, well, profits are bad. Profits mean I pay more tax. But you know what? Profits mean you've got a sustainable business that lasts for a while. A profit means that you've got money for things other than just paying bills. Profit means that you can pay yourself or the business owner a dividend or money to reward them for being the owner of a business who actually owns money, who earns a profit. So a profitable business is a business that we're looking for. And we do tax planning with profitable businesses because it's the profitable businesses that actually pay tax. If your business is not profitable, then we don't need to do tax planning for you. What we need to do is some cash management training and profitability training so that your business can start to make a profit so that you can then start to pay tax. Now, tax, I love this part. Tax is not a penalty. Tax is not a penalty for doing business. Tax is just an ordinary part of doing business, like paying your electricity, paying your phone bills, paying your suppliers, making sure that your employees or your wages are paid on time, making sure that your rent is paid on time. Taxes is exactly the same as this. Tax is not an afterthought. Tax is not something that is bad. Tax is a good thing. I just wanted to iterate that just here, right now. Tax is a good thing. So now we've got that understanding of how the tax system works, we then can help you with the tax planning to see when that timing of those taxes needs to be paid so that we can calculate and assess how much tax is going to be paid at what time so that you've got the right amount in your tax bank account so that you can pay that tax when it comes due as it's needed. And the money is just sitting there aside in the tax bank account, just doing its own thing. And generally, if you've got a good bank, you might get a little bit of interest on that tax money as well while you're waiting, while you're holding it, while you're not spending it on something else, waiting for the tax assessment to come up and for it to be paid. So what we do when we're looking through tax planning is we look at your profit and loss, but this isn't the only thing we look at when we're doing tax planning. And the reason for this is your profit and loss is a report that is used for calculating your taxes. It's not a report for how well your business is doing, not necessarily. There's lots of different factors that are here, there, and everywhere, and I might run through a couple of those if I think I've got time. But a profit and loss is a statement that we use to calculate your tax, but it's never complete until we as tax agents or accountants run our eyes over it and make sure that everything is included. And so I wanted to share with you the demo company profit and loss. So if you're using Xero as your bookkeeping software, then you can run a profit and loss statement. Now, the profit and loss statement here I've got in demo company is just the fictional company. And what we do with the profit and loss is we look at the numbers that are not just on the profit and loss, but what's missing from the profit and loss as well. So just briefly, before I run through the numbers and assessing how a profit and loss would work, is a profit and loss is a period of time report. So this report I've run is for the year ended 30th of June 2024. So even though we're in April at the moment, I've just included the full year's worth of data. Obviously, there's nothing much entered past today. There's nothing entered for May or June, but by the time we get to May and June, we would run this report and work it out. This is all of the data from the 1st of July through to the end of today, essentially. This report is excluding GST, so you won't find, if your business is registered for GST, you won't find that this number matches with your bank account. And there's a couple of reasons for this. Number one is because it's excluding GST, and what comes into your bank account is including GST. The second reason is that this profit and loss is based on the invoices entered into your system, regardless of whether they've been paid or not. Whereas your bank account is only the people who have paid you and had that money deposited. So there's that big discrepancy between the actual cash and what goes through your financial reports. And so this profit and loss report doesn't always and very rarely matches what goes through your bank account. So I just wanted to let you know that about this profit and loss report as well. And it's true for yours, not just Demo Company, it's true for all businesses. So what we're looking for on the profit and loss statement is what's in here, but also what's missing. So with this profit and loss, with this demo company, we've got an income of about $53,000. We've got some purchases of $763, giving us a gross profit of $52,000. So my first thing would be, what type of business is it? Is that purchases figure enough? Is it big enough? Or is it just hiding somewhere else? Then we've got other income. Sorry, I'm looking at the wrong screen. So other income of $97, and that's from interest from the bank, which is great. And then we've got the operating expenses. So the operating expenses are the things that you're spending out on the business, but it's not everything that we're spending out on the business. And a couple of things that we spend out on the business that aren't included in here are things like when we're paying our loans back. If we've got a loan for our business, we're paying our loans back. That's not included on our profit and loss. This belongs over in the balance sheet. Another one would be if we're buying equipment for our business. So if we've got tools or vehicles or trucks or diggers, then all of those would be showing on the balance sheet. They don't belong from a tax point of view. They don't belong in this profit and loss report. So from a tax point of view, we want to pick up those things that are sitting outside of this profit and loss report and bring in the appropriate items. So things like depreciation on the motor vehicles and the excavators and the trucks and all of the equipment that you might have bought. We need to calculate the depreciation based on the current tax rules. Now, the current tax rules are write off anything that cost less than $20,000. Now, a couple of years ago when COVID was, it was unlimited. You could buy whatever you liked and write it off as a cost to the business or a tax deduction to the business, but not this year. So we've got a cap of $20,000. So if you buy a $30,000 truck, then that will go through the depreciation rules and only a portion of it will be tax deductible and reduce the profit that you make. Similarly with loans, if you've got a loan that you're paying off, it's not the full amount of repayments that we're paying to the loan company or the bank, it is only the interest that's charged that needs to come into this profit and loss. So we do have to take into account a few different things, and what we'll do in the tax planning process is we'll work all of those out in advance and we'll push them into your profit and loss statement. So if we are looking at doing tax planning for you, you might notice a few extra things on your profit and loss that haven't been shown in there previously, and it's purely because we're just doing that tax return preparation early rather than later. Rather than after the 30th of June, we're doing it in April. So that's what we're looking at here. The other thing we want to look at is this profit figure. So with this demo company business, it's showing as a minus. So the brackets around it indicate that it's a minus, so it's not a profit to the business at all. In this situation, it's a loss to the business. So from a tax planning point of view, tax return, you're not going to have any tax to pay unless there's some major changes that happen. So you might have a big bulk lot of income come in. You might have a $40,000 invoice that shows up, which will push you back up into profit. Or we might run through some of the the things in here. So entertainment isn't always tax deductible, so we might take entertainment out. Legal fees, depending on what they're for, may or may not be tax deductible, so we may take some of those out. One of the other things that demo company always misses out for me, which is a great tax tip for us to look at, is superannuation. So we've got wages on this report of 40,200, and at 11% superannuation at the moment, we should be sitting over like more than $4,000 worth of superannuation. So this is actually not showing on this demo company, but it should be showing on your profit and loss. Now, the tax tip, highlight this one and put it in your calendar for the middle of June, is superannuation for April to June is tax deductible when it's paid. When it is paid. So if you pay it before June, and by paying it, I mean it needs to be received by the super fund before the end of June, it can be tax deductible in June. But if you pay it in July, then it's tax deductible in July. So that one, there's your first tax tip with relation to tax planning, is pay your superannuation early. I always start to recommend, well, I'm recommending now to all of my staff and also all of my clients, is get used to paying superannuation more frequently. So superannuation maximum is paid quarterly. So April to June supers due to be allocated to the super fund by the end of July. But if you can get into the habit of paying your superannuation monthly, that's going to make it a lot easier for you. By the time we get to July 2026, your superannuation is going to be paid on payday. So if you're doing payroll on a weekly basis, you're going to be paying your superannuation on a weekly basis as well. So this is another reason why it's really important to have money set aside so that you can pay your taxes and your super on time, rather than having it be an afterthought and later on. I'm going to stop sharing my screen again because my internet unstable thing keeps coming up. So definitely look at paying your superannuation early, whether that's on a monthly basis or just for June, get that paid, and have a look at what else needs to come into your profit and loss statement for tax purposes. Now, when it comes to calculating how much tax you'll need to put aside for tax returns, this is all of the things that we run through. So we look at your loans, we look at your assets, we look at where you're at now, and then what we do is we extrapolate that out. So we've just finished March, so we've got 9 months of data sitting in your data file. So whether you use MyOb or Xero or a spreadsheet, that's absolutely fine as well. We'll look at your 9 months worth of data. Generally, we'll divide it by 9, times it by 12 to get to an annualized figure. So if your current profit is $10,000, we'll divide that by 9, times it by 12, and we'll get to about, I'm going to go 9,000. Profit is $9,000. You'll generally end up with a $12,000 profit at the end of the year, give or take. So some of the questions we might ask you before we start doing our tax planning calculations are you planning to buy anything big, any assets? Are you planning to have any loans? Are you planning to pay yourself a bonus or pay yourself extra money? Are you planning to reduce or cut out any of the costs that you have? Are you planning to increase the number of staff that you have? Is your income on a steady trajectory, or is it going to go up significantly between April and June? What are your expectations of what's going to happen with your business so that we can give you the best estimate for tax as possible that we can? So lots of different questions that we ask, and depending on which service you go with, we'll either have it as a face-to-face conversation or we'll ask you in advance so that we can create a report for you. And I'll get to the what service in a little bit. The other thing we talk about with tax planning is business structures. So I said earlier about my client that I talked to yesterday. I called him Bob. One of the reasons why he came, he said, "Well, how can I save more money? And or no, not save more money. How can I pay less tax?" And I said, "Well, as a sole trader, the more income you earn, the more tax you're going to pay. So where are you at right now, and where do you think you're going to be?" And this is a good part of what we do in tax planning. Where are you at now? Where do you think you're going to be? He said, "Well, I'm holding myself back. I'm holding myself back on my income. I'm just doing the bare minimum because I'm scared of paying taxes." I said, "Okay, what are you doing with your money?" And he goes, "Well, I really want to buy a block of land down south." And I went, "You know what? If we set up a bank account so that you can buy a block of land down south and a percentage of all of your money goes into your tax bank account, so you know you've got all of your money set aside for tax, and you've got a bank account set aside for your block of land down south, and a percentage of all of your money can go into that block of land bank account, would that enable you to earn more money if you wanted to?" He goes, "Yeah, I would earn more money because it's got somewhere to go now. I wouldn't feel like I'm wasting it." And so that's another key part of what we talk about with our tax and strategy sessions, which is, what are you going to do with your business? What do you want to do with the profits? Because most people don't actually think to make a profit. They think to cover their costs. If you make a profit, what are you going to do with that profit to urge you on to make sure that you are getting the income that you want so that you can get this outcome that you want, this block of land, or whatever it is for you? It might be more holidays, or it might be to buy another piece of equipment, or it might be to buy a new house. So whatever it is for you, if we can set a bank account up for that and see that there's money going in there over and over again, then we can then help you work out how much that tax component is, so that you know that that money is going to go in there for that purpose and it's not going to be touched or drawn down on to pay your tax bills or any other bills as well. And what this does is it encourages us to get more income because there's a purpose for getting more income, but it also encourages us to look at and take stock of what we're spending our money on and cutting back the things that we don't need to spend our money on. Because if we're in the old mindset of don't want to make a profit because we don't want to pay taxes, then we'll spend all of that money. But if we now know that there's a purpose for our profit, and in Bob's example, it's to buy that block of land down south. If we know that we want to buy a block of land down south and we've got enough money set aside for taxes, then we've got a choice. Do I spend this money to buy this new piece of equipment? Or do I buy a second-hand piece of equipment for the same equipment for a lower price and put the extra money aside into my buy a new block of land account? And so it makes decision making really easy for you as a person, makes decision making really easy for the business as well. How can we save money to get more for this purpose, for this thing that we want? And that's a part of tax planning. Yes, it's goal setting. Yes, it's thinking about the future, but it's taking you out of the, "Oh my God, I'm working to pay the tax man," to, "Hooray, I'm working towards buying this piece of land, house, holiday, whatever your situation is." So hopefully that makes sense to you. And I'd love to know if you are resonating with anything that I'm talking about today. So I'm just going to take a quick drink. If you can put in the chat what's come up for you today from everything that I've talked about so far. What's been your aha moment? Paying super early is a good thing. Yes, it is. And soon we'll have to actually pay it on payday. So if we get into the habit of paying it early now, by the time we get to 2026, it's not going to be a shock to the system. And Danielle, learning about different taxes and setting a profit goal. Absolutely. Um, the profit goal is the one main thing that drives so many more people. When I teach them this system, it's like, wow, yeah, okay, let's go. Let's make profits in our business, because it is a little bit like winning the lottery, running a business. You can earn lots of money if you decide to. If you so Kat, you've got, so it's not true that if you don't pay super on time, it's not tax deductible at all. There's different layers to that. So generally, no, it's not tax deductible. But there's penalties if you pay it late. So if you pay it late, you've got to pay the super guarantee charge, and that portion of it is not tax deductible at all. But if you do eventually pay it, so if you pay it in July, it's tax deductible next year. So it'll be tax deductible in the 24-25 year, even though it was super for the 23-24 year. How long until you get the penalty? Well, if you pay 1 day late, then you're required, and it's a self-assessment system with superannuation. So it's not many people fill it out and do it, but essentially if you pay a day late, then the penalty applies, but you have to tell the tax office that you're a day late, and you have to fill the forms out yourself, and you have to notify them, and then you have to pay. So a lot of people just put their head in the sand and ignore that, and then sometimes it can come back and bite them a little bit later. And Robin, new future with maximising money. Yes, good work. Reach out, Kat, and put any more in if you have more questions about paying superannuation late. Awesome. So with Bob, we talked yesterday about setting that goal for that block of land. I'll get to this one. And then we talked about structure. So currently operating as a sole trader, what would it look like operating as a company? So with the individual tax rates, the more you earn, the more taxes payable as a percentage over and above that particular tax bracket. So off the top of my head, because I don't actually have it open, $0 to $45,000, $45,000 to $120,000, $120,000 to $180,000, and then $180,000 plus. So each of those brackets have a percentage, but you're not paying that full percentage for the whole amount of income that you earn. Everything you earn up until $45,000 is taxed at 19% in the dollar, and then it caps out at that 19%, and the next lot I think is 32.5%, and it goes on and on and on. So around that $125,000 mark is where it's beneficial to start thinking about operating as a company instead of operating as a sole trader. And so for every single client that we talk to, we have this conversation around tax planning of what's the most effective tax structure for you, and is it right for you at the moment? So we went through Bob's situation, and he's not using Xero at the moment. He doesn't have all of his bank accounts set up, and he's not working the system well, so he's scared. He's not doing his bookkeeping regularly. I said, you know what? Let's not set you up as a company just today. Let's wait a couple of months to get the systems and the structure in place. And then once you've got the systems and the structure in place, and you know you want to earn more money, because you've got a purpose now of buying this block of land, and we can see that there's an uptake in income and you are earning more money than what you have in the previous few months, then we'll look at setting up a company then. So a company setup is one where you earn as much money as you can, and you pay you pay tax on your profits at a set flat percentage. So at the moment, the set percentage is 25%. So if you earn profit of $10,000 for the year operating as a company, then you'll pay 25% of that as tax, so $2,500. And a lot of people go, oh, well, that's a lot of money. Yes, but you get The business keeps the other $7,500 as income, as profits, and that can be then sent out to the owners of the shares and received as dividends, and they receive that with that tax component sent through as well. So just because a company has a flat rate of tax doesn't mean that a company is going to be your best strategy for saving tax. It might be your best strategy is to look at what you're spending, invest in the business a little bit, but just keep the money aside for tax. And the reason for this is because you get a tax deduction based on your tax rate, based on how much you pay. So if you're paying $1,000 for something, I'm going to say for a computer, $1,000 for a computer, you're only going to save the percentage of tax that your tax rate is. So a company will save $250 worth of tax for spending $1,000 on a new computer. If you're a individual, so a sole trader, and you're sitting around that $120,000, $130,000 profit mark, that tax rate is 37 cents in the dollar. So for every $1,000 that you spend, you're going to save $370 worth of tax. So it's more money you're saving as a sole trader by being deliberate about whereabouts you're spending, what you're going to do, what your long-term plans are, what your short-term plans are, as to what's going to be the most effective tax structure. So it's not necessarily going to be a company if you've got plans to spend money. It's not necessarily going to be a good structure staying as a sole trader if you're planning to put guys on to grow your business, to be to invest in lots of different machinery, to be a bigger business than what you are. So we always talk to the client and make sure that we get the right scenarios and the right flow before we push you and change you into something else. Now, another question I often get asked in here, what about a trust? Can I save tax in a trust? And the short answer to that is no. You can't always save money in a trust. A trust is good because it's got flexibility over who the owners are or who the beneficiaries are as to who can pay the money on the trust, pay the tax on the profits of the trust. But if the trust is highly profitable, I generally see that what happens is it actually creates more of a tax issue having a highly profitable trust than having your business run through a company. So yet again, we've got to look at all of the facts of your business, who's available in your business, who's running, who's making decisions, who's available, what everybody's tax rates are, as to when a trust would be more beneficial than a company, which would be more beneficial than a sole trader. You may note that I'm not saying partnership in here, and the reason is we don't often set up partnerships anymore because of the joint and several liability of both partners, and the at-risk state of a lot of small businesses going under within the first 5 years. So there's a high risk of business going under in 5 years. So therefore, if you end your business with a $20,000 debt, you both are liable to pay that debt. So it's not something that we tend to push having a partnership structure. Okie dokie, Kat, back to your question. My accountant last year didn't lodge my BAS on time, even though I was organised and had a meeting with them on time. There was a $1,200 fine. Oh my goodness. Absolutely, yes, ask the accountant to pay it. If you have done everything on your part, it may have been an oversight on their part that they didn't lodge on time. And they may be able to request a remission from the tax office. So ask the tax office to just remove that fine. But if you don't ask, you don't get. So ask them, hey, I had a meeting with you on such and such date. All my stuff was prepared, but it was lodged late and we got a fine. So could you help with that, please? And what's the worst that could happen? They could say no. And you could go find another accountant. Or they could say yes. The tax date deadlines for all of the current financial year. If you're on our email list or if you're on our Facebook page, we publish, I don't have it up, we publish all of the due dates for all of the forms coming up. We call it the departures board. So we've got a little flat theme going on with our business where the departures board shows what date each of the form is due to be started and then due to be lodged. So generally though, Chelsea, it's the 21st of the month for monthly basis. So that's your pay-as-you-go withholding and GST if you're paying GST on a monthly basis. It's the roughly 6 weeks after the end of quarter for a BAS. And then your tax return depends on whether you're a large taxpayer or a small taxpayer, but most tax returns are due on the 15th of May, especially for our client database, which is small business. So hopefully that helps. Otherwise, jump on our socials or in our newsletter. You'll see the departure board in there. Okie dokie. So what does tax planning look like? So hopefully my internet's a little bit stronger this time. Share my screen. With tax planning at Northwest Accountancy, we have a 3-tiered system for our tax planning. So if you're a sole trader, we're happy to have a single conversation with you about your tax planning. So we'll jump in a call with you, whether that's face-to-face if you're based in Karratha or online. And I'll give you the list to the mailing list, Kat. Thank you for that. So we'll do a face-to-face or a Zoom meeting with your accountant. So myself, I've got Kat, I've got Mary, I've got Talini, and I've also got Carrie who does tax planning as well. So those are our accountants who will have a tax discussion with you. As a sole trader, we'll also talk to you about how much your estimated tax bill is and how much to put aside for your tax and roughly when it's due to be paid, so that you know you've got that heads up of when it's going to come through. And then we'll give you some strategies to reduce your tax. So I've already given you a couple of strategies today. So paying your super on time. What else did I say? Having a tax bank account set up. And so with the sole trader, we'll just sit down for an hour or so meeting, make sure that everything's okay, give you those timelines and a couple of things that you can do to work out whether you've got tax to pay or not and how much that'll be. Now, if you're a small business, so we've got a tax plan, which is a $990 investment. So we'll do the same thing as with a sole trader. We'll sit down, have a discussion with you. We'll tell you how much tax to put aside, what those strategies can be. We'll also talk about those bank accounts as well. So how can you improve your business cash flow with Profit First? Then we'll have some key performance indicators for you as well. So what are those things that come up and you can track yourself on a regular basis to see how your business is going? So it might be, and there's lots and lots of different key performance indicators that we run through, but it might be, how is your wages going as a percentage of income? What is your owner's pay as a percentage of income? What are your materials or your cost of goods sold as a percentage of income? And these are things you can then track. And if your prices are going up or if your costs are going up, but not your income, then you can see that by percentages rather than having dollar calculations, which is a little bit hard to monitor dollars versus percentages with your key performance indicators. So that's your tax plan. So we have a look at your Xero file or your MyOb or whatever documentation you have, and then we'll sit with you and have a meeting, and then we'll work through some of those strategies with you. Now, the final one, the tax strategy session. Now, this is tax and strategy, and this is for our proactive businesses. You can see there that the price is $3,300. And what this encompasses is a whole load of where is your business at now? Where do you want to be? So future planning to see where your business is taking you, defining that purpose. So like I said with Bob, with his block of land, You might have several things with your business. So how can we help you set that up using bank accounts, using structures, using tax planning, using timing to get you where you want to go in the time frame that you want? We'll give you some strategies on how to pay yourself more, and we'll make sure that your business structure is working for you. And if there's any recommendations, we'll recommend and give you specialist advice for your business. Now, your tax and strategy session comes with a survey beforehand. It comes with a 2-hour meeting, and then it comes with a report at the end as well. So it's a lot of money, but it's a full-on deep dive into your business for you to stop, take stock of where you're at, and look up from running the business and being day-to-day in the business, and actually get some planning and roadmap into play. So I know that there are probably people on the call or watching that are already in our system, already booked in for the tax strategy sessions. We have 5 clients already booked in. So if you want to be a part of the tax strategy sessions, then you are welcome to join us. If you want to just give the tax plan a go for this year, then you're absolutely welcome to do that as well. I've just put a poll up in the chat here saying, are you interested in joining us for tax planning? So if you are interested in working with Northwest Accountancy with myself or one of my team to run through your tax strategy or tax plan for 2024, then please put a yes, contact me, or a yes, I'll be in touch, or a not at this stage in the poll. And then once the session's finished today, we'll reach out by email and then run through what it is. And if it's absolutely okay to say not at this stage, by the way, as well. Absolutely okay. Today is a session that's all about information and giving you that skill of what is it that you want to do. So feel free to say yes or no in that poll. I'm going to stop my share. And so what I'm going to do, I'll leave that poll open for another moment. So then what we're going to do is just quickly wrap up. So what I've talked about today: getting businesses to be more proactive instead of reactive by setting up tax bank accounts and having that amount allocating to your tax bank account every single week, rather than working. Oh crap, there's a tax. Working to pay the tax. So we want you to be more proactive with your tax and have an allocation of tax to that tax bank account every single week. Then talking about how tax is not scary. So by doing tax planning, by showing up today and learning a little bit about the timing of tax, how tax is calculated, and some of the strategies we talk about, you're now reducing the scariness of tax. It's not so scary. And being not so scared of tax means that you can put that foot forward and ask your accountant, what can I do to save taxes? What can I do to reduce or minimize my tax? And you're allowed to minimize your tax. It's absolutely legal to minimize your tax. Avoiding tax is illegal. Don't avoid tax. Minimize tax. Yes. Looking at how the reports were run and calculated, the things that are missing off a standard profit and loss and when they might be added, and then talking about structure. So if you do have any questions, please stick them in the chat. Kat, I will get back to you. I'll send you an email on how to get into our mailing list. I think, I'm going to double check, I think you'll be automatically added to our mailing list by attending today. So I'll double check with that. If you do have any questions, please just stick them in the chat. I am 6 minutes earlier. This never happens. So I'm super excited. So if you would like to join us with some meaningful tax planning and be added to our list, be more proactive and less reactive about your tax, then I would love to have you. Tax is not scary. So that's what I want to leave you with today. Tax is not scary.